and the markets have seemingly stalled. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we had an interesting day today, and an interesting several days, stand out in that they've brought next to nothing in terms of major developments in these markets. A bit cooler on stocks, a bit spicier on the dollar, which has pulled back a touch, but generally speaking, very quiet in these markets over the past several days. And of course, the question now in front of us is, are we going to see some trend development this week? And of course, to answer that question, we are going to have a look at what will be the major macro inflection points this week and see if any of that is going to give us an opportunity for these markets to actually get someplace and give us some sense of directional development. So we'll begin here with just a brief look at what these markets did last week. And what you immediately see is there is a relative quiet here, just in the performance of the major assets, even just starting at equities here. We can see very quiet week ultimately for the usual suspects. The S&P up a mere 0.6% after a big rally the previous week. The NASDAQ basically flat after a big rally in the previous week. Nothing much going on with yields, a little bit higher on the 10-year, a little bit higher on the 2-year after big sell-offs in the previous week. Crude oil enjoying a bit more of a corrective rise, still sort of marching to the beat of its own drum here, not really paying attention to broader dynamics. The dollar slightly stronger. The euro here, the avatar for the dollar's overall direction, its most liquid counterpart here. And we can see here the euro down 0.1% last week after being down 0.6% the prior week. So a touch stronger on the dollar over the past 2 weeks, but nothing really huge to speak of. Gold basically treading water, down close to a percent in the past week, up about 1% in the prior week. Really, gold hasn't gone much of anywhere for a few weeks now, essentially stuck in a narrow range between, call it 2,300 and 2,440 to 2,450, something like this. No real movement one way or another. So a sort of grass is growing, paint is drying week for markets last week. And the question now really, do we have catalysts to change that this week? And the economic calendar is, if anything, more bare bones this week than it was the last. But there are some interesting points to consider. And the first is going to come at us by way of Canada's CPI data, the Consumer Price Index, the benchmark measure of inflation. And here we're looking at the headline rate coming down to 2.6%. That would be the lowest in over 3 years. The core seen holding unchanged at 1.6%. That was already a 3-year low when it registered there in April. These are, of course, May numbers that we're looking at here. So the process of disinflation very much ongoing here. The Bank of Canada, of course, has already cut rates by 25 basis points, ending its standstill after what was the same sort of a rate hike cycle that we had out of a lot of the major economies in the wake of COVID, where inflation spiked across the world, with very few exceptions. China, of course, being the glaring one, because that economy continues to essentially subsist on life support still now. But most of the world saw a large inflationary spike, be it Europe, be it the US, be it most of East Asia, like Japan, let's say. And so the same sort of dynamics have occurred. A lot of those central banks moved into an aggressive rate hike cycle, echoing that of the Fed in 2022, and have since wrapped that rate hike cycle and are looking for the spots where they'll begin to bring rates back down. For Canada, that began this month. They came down from 5% to 4.75. And the question really in this CPI data is going to be, will they do more? How much more? And what implications for the markets there are therein? If we look at the way that Canadian economic data has been performing recently, we can see it's actually improved somewhat relative to forecasts. We can see here there was a fairly violent dip the wrong way at the start of this year, and we've now recovered above this important zero line on the City Economic Surprise Index for Canada, which means that economic data that's coming out is now tending to beat relative to forecasts. On top of all of this, the latest numbers on business activity, the PMI survey out of Canada via S&P Global, is showing us that there's been a notable uptick. In fact, this is actually the first time that the private sector activity growth measure here has moved into expansion territory. Here's the 50 line. This is sort of boom bust level for PMI, and you can see GDP is something that is represented by the gray bars there in the back, and you can see that there is a level of some tracking. Obviously, there's important deviations here, but we can see that generally speaking, there is an echoing of the PMIs back to GDP. And so this move back above 50 suggests we're expanding for the first time in a year in Canada, on top of the economic data getting a little bit better than expected, at least as Citigroup would show it here. So the risk is that this CPI data in sort of in parallel with these developments is a little bit hotter. In fact, the PMI data suggested that, in fact, employment had picked up and inflation had picked up alongside growth, which is what you would expect to see. So we have then a situation where maybe this number comes in a little bit hotter, and then so maybe the tally for the remaining rate cuts for the Bank of Canada is going to be diluted here somewhat. Now, as it stands, the market is looking for 46 further basis points in easing. The year-end rate here expected to be 4.3, 4.29 to 8, something along those lines. Here, if you look at where this is, sort of here's 4.2, here is about 4.3. So this essentially means that we are almost fully priced for 2 more cuts this year. 46 basis points out of 50 basis points baked in. That amounts to a 92% chance of having a pair of cuts more. If the number is going to be a little bit warmer on the CPI side of things, then of course this calculus might change. And so with that in mind, this represents something of a market moving possibility for the Canadian dollar. If we get a warmer number, this readjusts to perhaps a year-end rate closer to 4.5. So maybe we lose some of that second cut possibility. Then we go into a world perhaps where the Canadian dollar has room to tick a bit higher. The second notable development here, and the third, are essentially flavors of the same narrative. And of course, that narrative is where the Fed is going next. Now, we can see here that Fed policy expectations have essentially anchored. So we can see that really since April or so, mid-April, early May, that there has been an anchoring of where monetary policy is going this year. The Fed, of course, met on May the 1st and essentially said, you know what, we're disappointed that inflation has stalled and that it's not moving lower faster. So we're going to adopt a higher for longer sort of posture. And when they met this month, despite the fact that inflation had resumed its march downward, we saw a similar sort of thing where the Fed reduced the number of rate cuts it was expecting for this year, as if to say, the cuts are coming, they're just not coming quite as soon. No hikes were certainly introduced into the forecast. And so the gray bars here is the outlook for 2024. The yellow is for 2025. The orange line here is the cumulative amount of cuts across the period from now until the end of next year. And we can see that the yellow area here has widened out, which is to say more cuts have moved into next year's outlook, while this year has stood still. Stocks have, of course, liked this, as they tend to do. And so as we've had the cumulative rate cut tally build out, stocks have gone higher. As that has stalled here in the past several days, week and a half or so, stocks have likewise stalled. And so the things that we're going to be looking at here, the next big catalysts, really speak to this. The first is the backdrop politically, because of course we have the first debate of the presidential contest this week. And it is tempting to write it off as not something that really needs to be paid attention to. This is, of course, a rematch. We've seen this contest before. Both the current president, Joe Biden, and his challenger, Donald Trump, have been president before. These are, to some extent, known quantities. So it's tempting to say that the market has already benchmarked largely and baked in either one of these outcomes. It is also not lost, surely, on anybody that the differences in key policy on the economic side of things are not necessarily that great. Both administrations have shown a penchant for expansionary fiscal policy. From the Trump administration, it was more via tax cuts. From the Biden administration, it's more via spending. Either way, you have expansionary fiscal policy one way or another. There's an agreement on the trade side of things, a much more combative, much more deglobalization-minded perspective, much more industrial policy perspective on the stance on trade from both of these administrations, especially vis-a-vis countering China. So again, it's tempting to think that this is not really a major thing to consider from a market's perspective. But nevertheless, there is a framing exercise to be had here. This is the first time that we're going to get a direct face-to-face contest here. And so, if nothing else, it'll be interesting to see what the markets do with it. There are, of course, some important policy differences. Not necessarily official policy differences, but there's been a lot of talk around a would-be rerun of a Trump administration would be much more involved in managing the role of the Fed, that it might look to crimp some of the Fed's independence in setting in interest rates, that Jerome Powell might not be renominated if there were a Trump return to the White House, and what that might mean in this sort of whole story around rates and normalizing policy and inflation and so forth. So there are differences. It's unclear that they're the kind of differences the markets are prepared to care about, or that policy might actually come out of in practical terms. And so what's interesting here will be to see how all of these market variables, be they the priced in policy outlook, be it what the situation is on inflation expectations, which incidentally have been moving lower. Here's the 5-year break even, the 10-year break even, the 20-year break even. The path of inflation expectations really since April or so has been unequivocally down, and since the end of May and June, actually the expected path of inflation has accelerated lower. We can see here that the Fed is within a hair of getting the 5-year rate, for example, to its target of 2%. So we're looking at this and sort of considering, if the dollar responds, if the treasury market responds, if the priced in outlook responds, if the break-even rates respond, that will be an interesting filter to essentially say, okay, well, how did the debate go? Who do we think did well? Now, how did the markets respond? Okay, so when we put those things together, what does that suggest about whether the markets care or don't care, or whether there is some sort of a directional filter that the election offers? So the debate is, to some extent, a framing exercise that way. And it will be interesting to watch from that perspective. For what it's worth, we can see that U.S. economic activity, again, looking at the latest that we have on this, the PMIs, does seem to be trending the right way. So we can see here, of course, here is the depths of the COVID normalization. This was, of course, COVID itself. This was the run-up and the catch-up rally once the economy was turned back on. And we can see here that moderation has already occurred, and now we're trending back higher. So the economy is, helpfully, on a healthy path, it would seem. Growth is not dramatic, but it's moving in the right direction, and it's now in the vicinity of where we were before COVID. It should also be pointed out that before the onset of COVID, the trend was down, and it is now up. So we're looking at a situation that ostensibly looks supportive, and we'll see to what extent the market is prepared to do anything around these election signals, given a backdrop of growth doing better, inflation going lower, as far as expectations are concerned. It is the same story when we get to the end of the week, and the last bit of meaningful event risk here, the Fed's favorite inflation gauge, the PCE index. Here, we're looking for the core and the headline to come in line with each other, as it were, at 2.6% year on year. For the headline, that'll be a 3-month low. For the core, it'll be a 3-year low. And that's, of course, because of these shenanigans over recent months with energy stopping its negative contribution and becoming a lightly positive contribution to the overall mix. The markets generally are pretty good at forecasting what the PCE number is going to be, having seen, as they already have, of course, the CPI and the PPI releases. So meaningful surprises here seem unlikely. The big question, of course, will be perhaps less so whether the numbers shock anyone, but and more so, will this be a situation where we get something unlocked in the markets once the event risk has passed? Will we have something like a situation where you get event risk out of the way and the market is allowed the space to have conviction to go whichever way it wanted to go already? And that might be, similar to the debate in some sense, a helpful framing exercise to essentially say, okay, well, if there's nothing that's going to be changed by the passage of this event risk vis-a-vis the Fed policy outlook, what is the market going to do once that event risk is in the rear view? Will it default higher on risk and thereby on stocks, maybe lower on dollar, or will it go the other way? And so I'm less interested, as it were, in the substance of this report, unless, of course, there is some sort of out of sorts deviation, and more so in what the markets do in the wake of the outcome. And that is the view here for the week. As I say, it's a bit bare bones when it comes to how much event risk is actually on the calendar in terms of the big headline developments. But it will be interesting, nevertheless, to see what the default is that the markets come up with once all is said and done. As ever, Macro Money is here every day, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what happens thereafter. I'll be on with Victor Jones for the Price of Truth later this week. I'll be back on with Chris for Futures Power Hour on Friday, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.